I have like 25 questions for him, but I'm not going to ask all of them today because you guys would be here all night. So can I?
Sure.
We'll have other questions for you.
Sure. Let's have a glass of water.
You can have a glass of water.
Thank you.
I guess the question that a lot of people ask.
You said, my phone rang. You said, I thought you ought to call him. It was my daughter.
So a lot of questions that people ask. One of the bigger questions people ask is, hey, what happens if the Fed goes crazy and raises rates 1%? Like, because they said originally they would raise it maybe 1% for the year. Let's say in December they go crazy and they raise it 1%.
So I would just say that would be so out of character because the Federal Reserve, since all the way back in 1994, has done nothing that's been crazy. They've telegraphed, they've told you, other than saying they're going to raise rates and then not raising rates, which I think is crazy, but as far as them getting aggressive or spooking the global markets or putting us into a recession, the thing you have to remember is when the Fed raises rates, first of all, the Fed's the bank's bank, right? That's their job, to protect the banking system. So they spent since '08 rebuilding the banking system, having giving them cheap money to lend long. The curve was steep, positively sloped. So they're borrowing money at 25 basis points from the Fed window. They're giving you a mortgage at 4%. That's their margin. That's how they make their money. So now, with all this negative yields around the world, as the Fed raises rates, long rates aren't going to go up. The curve's going to flatten. So it's going to take away their profitability. So they got to be cautious on taking all the profit they gave back to the banks and rebuilding their balance sheets by raising rates. The dollar will get stronger typically when you raise rates, which will hurt our GDP because of our, the manufacturing will get hurt, any exports will get hurt. So it's a very sensitive subject. That's why we're so concerned with international development stuff. How's it going to impact the international developments? What's going to happen over there? Unless all the central banks are doing the same thing, it's going to be very, very difficult for us to do. I'd say one this year, we'd be lucky to get 1 or 2 next year. So I think it's going to be very gradual, very slow. Rates will stay low for longer. Growth will remain around 1.5 or 2%. I just don't see it changing.
The second question that a lot of people ask me is, hey Peter, I'm so concerned about the US dollar that I should invest in either gold or other currencies. How is that going to affect both the domestic and international bond market?
Yeah,
if that happens?
So the funny thing this year is because the Fed didn't raise rates only back in December, the dollar versus the index we look at, which is a basket of the other G20s, it's actually down 4% in the dollar. So that's why manufacturing has actually done well. That's why we were able to go out and buy other currencies. Currencies are very, very tricky. So I hired a guy from Franklin Templeton who came up. He was with us, and I was like, fundamentals I got right in Mexico. I got the company right. Everything was right except the currency lost more than the coupon on the bond. It's down 7%. I don't get it. He's like, it's all about where the money's flowing. Soros, Franklin Templeton, all the big guys, where the money's flowing, throw that on top of the fundamentals, and that's how you make money. And virtually, since he's joined us, there's a few other things we do, obviously analysis, but we follow sort of the technical flow, where the money's going. So you got to be very careful. Very difficult to do on your own. And currencies are crazy because if they go against you, then it takes away from your return. It's a return of your own capital. So you got to be very careful. And somebody says, well, why don't we just hedge? Well, the cost to hedge is so expensive that if I buy, let's say I ran out and bought Indonesia at 7%. If I hedged it, the cost would be so expensive, I'd get back a US T-bill-like return. So I'm like, why would I take the risk of spending all that money to hedge it when I'm just buy a US T-bill? It's called interest rate parity. Basically, puts the bonds back in parity, but it's so prohibitively expensive.
Okay, so I have only 23 more questions. But I see the salads are here. One last question while I show the salads. Unless somebody wants to beat me with a question. I got a question that everybody asks me. So these are the questions that people ask me. Okay, so stock market has done mostly really well in the last 7 years. Interest rates have been ridiculously low. Why should we invest in any bonds?
I think I gave you a good overview that I would agree with you. The treasury market I'd stay away from. I don't think the treasury market has value, but there's so many other sectors out there that don't have value. There's so many. The opportunity set has grown so immensely. that I'll give you an example. So 2003 through '06, my flagship fund, which is very similar to MINC, my flagship mutual fund, rates went up 17 times in that period. My fund gave you the coupon that we were paying plus an additional 1% in total return. So you actually made money in a bond fund when rates went up. Sort of counterintuitive, but I don't own treasuries, which are the most impacted. I own credit products, which is high yield, bank loans, corporates, things that give you a big spread or an additional yield over treasuries. The economy's doing good, they're raising rates. Usually the spread's compressing faster than rates are backing up.
Okay.
Very simple.
Last question. I lied. So last question. A lot of people are moving from mutual funds to what we're talking about, which is exchange traded funds. How has that changed your business?
So you guys use actively managed ETFs, which is very similar to a mutual fund. So it's basically very, very similar to the mutual fund. The indexed ETFs have changed my business, and I can't talk for the equities, but I'll talk for high yield. ETFs represent 4% of the high yield market, so a small portion. They're 80% of the volatility of the market. Is that obscene? It's sort of crazy, and I'll give you an example. So we know an ETF had a $1.9 billion redemption on Friday. Coming on Monday, we get a call from the street. Hey, can you take some MGM, 2010s off our hands? Like, where are they offered? 99. We'll bid you 90. If you swear, we're taking up the phone. 20 minutes later, they call you back. Can you do them at 98? They have to get rid of those bonds. So even though it's one of the biggest high-quality bonds, they have to sell them. They're creating volatility in the market for no reason other than incoming and outgoing flows into the ETFs. So they create a lot of volatility in my market. Actively managed like a mutual fund. If I get a redemption in our ETF, I can sell a treasury, I can sell a corporate bond, I can sell whatever I want. I have to sell something that's under pressure. Index ETF has to sell a small portion of every one of those things in the index so they're still index-like. So it creates volatility.
Well, that was excellent.